Welcome back to the channel, everyone. Today I want to talk about how Citadel is going bankrupt and how they're desperate for cash, desperate for loans, and any kind of margin they can possibly get their hands on. So stay tuned and let's make some money. And I want to dive straight in with the key information. So, Hang Loose tweeted saying, just in, Citadel seems to be in trouble. They just took out more loans with 8 different major banks, all within the last 3 weeks. He said these are ISDA master agreements for margin, where they've posted collateral with each bank to receive lines of credit. So Citadel has just entered into loan agreements with HSBC Bank, with Merrill Lynch International, with JP Morgan Chase, with Goldman Sachs International, with Barclays Bank, with Citibank, with BofA Securities, and with Morgan Stanley. Each of these loan agreements contain a fixed charge. Now that means that Citadel has provided collateral, aka in the form of stocks, for cash loans from these major banks. And as Hang Loose tweeted, he said if Citadel was merely liquidating this European branch to reorganise its assets into its hedge fund management subsidiary, then a direct transfer or use of one custodial bank as a third party would have sufficed. But instead, here they are raising more capital and taking out more margin loans by taking on more debt obligations. Additionally, transactions like this give the banks an opportunity to rehypothecate even more with the collateral they've just received. aka many of these banks could potentially use the security or the securities that Citadel has provided and lend out these securities even if they've already been lent out multiple times over. aka they could be lending out the exact same AMC shares to multiple different hedge funds for them all to short, even though they're all shorting the exact same share. That's rehypothecation. And Hang Loose said surely they'll put it to use to short us more, but hey, that's just more moon tickets for us. And one of the biggest things nobody is talking about is the massive change in the market making landscape, i.e. the expiration of the pandemic locate exemption order. For the last 30 months, the DTCC allowed these market makers to go crazy selling shares without needing to locate or abide by regulation SHO rules. This document, which was posted back in 2020, says the DTCC has intermittently suspended physical securities processing services provided by the DTC, its subsidiary, due to ongoing concerns related to the pandemic. While the DTCC has resumed limited services for new physical securities transactions, there's likely to be delays in settlement for the sales of equity securities that the seller is deemed to own, pursuant to Rule 200 of Regulation SHO. Now 30 months from March of 2020 takes us to the very end of August 2022, aka to the very start of September, aka basically now. And Hang said with this regulation no longer in play, the market makers now have to find other loopholes, but it definitely makes their life a bit harder. And he said we'll see what shakes out from all of this, but it's awfully funny timing to see so many overall market aspects looking sour right as this exemption order expired. We had nearly 50 million APE FTDs on a single day. We've seen tons and tons of stocks like HAD being pumped, obviously to create additional liquidity for these hedge funds, which I'll touch on a little bit later. But it seems to all be happening at a very coincidental timing, just as this exemption order expired. And Hang said while Citadel and Co continue to act like all is well in the world, lots of other factors are suggesting differently. Don't forget, for the first time ever, they just sold 21% stake in their company as of last December. Citadel also pulled back $2 billion that it lent to Melvin Capital and took on another loan of $500 or $600 million. You may remember this article from mid-August that said Citadel Securities recently borrowed $600 million on Thursday to bolster its balance sheet. Now obviously a balance sheet doesn't need to be bolstered unless the company is in a very bad way and they're desperate for cash and desperate for liquidity. It says the company, which is majority owned by billionaire Ken Griffin, because obviously Ken just sold off 21% of the company, that it planned to use the $600 million in part for additional trading capital. Citadel must be very underwater on their short positions, they must be losing incredibly on their long positions, and they must be very close to being liquidated, and therefore they're desperate for this additional trading capital. They need this additional trading capital to meet their margin requirements, to meet their collateral requirements, and to avoid being temporarily margin called. We know that Citadel currently has a credit rating of Baa3 or BBB-, which is obviously one step away from being a junk credit rating. Citadel is basically classed as being non-investment grade, aka very risky to do business with. And as Hang tweeted, Citadel also blocked investor withdrawals, so investors can only withdraw 5% of their capital every single quarter. A healthy company doesn't need to pull all of these moves. And as Perfume tweeted, he said if Kenny is having to borrow money and is having to set up all of these new loan agreements for new margin loans, I'd say he's got a big problem. And on top of that, as Jan-Jack tweeted, he said Citadel and the cash-strapped and near-bankrupt short sellers are setting a trap again with HKD. You may have seen HKD the other day was again up 286% at $177, and at one point it ran all the way to $381 and above as well. Clearly these funds are still desperate for cash and they're still desperate for collateral and liquidity, therefore they're going back to their old pump stocks and repumping them again to generate more money. And he said let them play that game with their own money. Now that short sellers' liquidity is trapped in asset bubbles and in their short positions in AMC and GameStop, they're trying to be creative to generate additional cash. But obviously by now we know their game, we know they're desperate for cash, and we know that they're doing absolutely anything they possibly can to meet their margin requirements. And on top of that, Reuters also posted this article saying that US tech-focused hedge funds are bracing for heavy losses amid the market slide. Reuters obviously expects the market to slide further and expects many of these hedge funds to take even heavier losses. And if that is the case, funds like Citadel will almost certainly end up being liquidated over the coming few months. It said US hedge funds that focus broadly on technology investments are bracing for heavier losses this year as gloomier economic data sparked a fresh sell-off this week, shrinking hopes of clawing back any significant ground in the coming months. Of course, speakers at a panel urged investors to stick with their bets, arguing the downturn could become a money-making opportunity, but off-stage behind closed doors, the mood was obviously much darker. Obviously these big funds, the Fed and the SEC is continually telling us the market is fine and to continue buying up stocks, but obviously just make sure that you sell your AMC. But the reason why they're telling us to buy up stocks is so we can effectively be exit liquidity for these hedge funds. Obviously, as I said in one of my previous videos, for every buyer, there must be a seller, and for every seller, there must be a buyer. If we're buying these stocks, it's because the hedge funds are dumping their trash directly to us. And they've said it would take a lot of work to get out of this hole. Even before this week's decline, funds that bet on technology and healthcare stocks were feeling the pain. Many of these hedge funds are down 38%, 39%, 50%, and even more. And as Marco Metzler posted, he said Citadel is also likely shorting US government bonds, which will lead to the mother of all margin calls and thus the financial meltdown of the global financial system. He said Citadel is playing the same crime game with US government bonds as it has with other meme stocks. This is possible because the Fed is offering free money in the repo and reverse repo markets. He said Citadel has shorted the treasury bond market beyond recognition using the repo market. Citadel owns a company called Palafox Trading and uses it exclusively to short sell and trade treasury bonds. Palafox in turn manages the Citadel Global Fixed Income Master Fund Limited. Total assets are over $123 million for that one singular fund, and 80% of that is owned by offshore investors in the Cayman Islands. He said their reverse repo agreements are fully rehypothecated and they cannot repay their own repo agreements until somebody pays them first. He said the entire global financial economy is built on a fractional reserve system that will very soon experience the mother of all market collapses. We know the treasury bond market has been absolutely destroyed this year, and we know the reverse repo and repo markets are also maxed out. The reverse repo facility has maintained around this $2.2 trillion level every single day for over 90 days now, since the start of June. That's because these hedge funds, these market makers, and these major institutions have maxed out their borrowing in the reverse repo market, and they're borrowing as much as they possibly can without causing a crash. But obviously, as soon as the S&P 500 falls further and takes out those May lows, these banks will all of a sudden need to borrow more money, but there will be no money left. And obviously this will cause a further crash in the stock market. It will cause many hedge funds and many institutions to be liquidated. They'll be forced to sell off their shares, exacerbating the crash, and they'll be forced to close out of their short positions when the fund is liquidated. And obviously the closing of those short positions is what will cause the AMC squeeze. And on top of that, Frey tweeted saying from the My Stock Portfolio app, Ape has a mere short percentage of 962%. This is obviously another one of those data glitches that won't be fixed because it's likely absolutely true that Ape potentially even has a short interest percentage of 962%. And as Swing Trader Mars tweeted, he said he's ran all of the FTD data for the entire of 2022. And he said Ape had more FTDs in its first 2 days of trading compared to any stock not on the OTC in all of 2022 for the entire New York Stock Exchange. AK, Ape racked up more FTDs than any other stock in the entire market has racked up every single day in 2022 to the date today, Friday the 16th of September. And he said, Adam Aaron, I respectfully ask, is this not proof of malfeasance by prime brokers and market makers with our stock? Having more FTDs in 2 days than most other stocks have had in an entire year is obviously a clear sign of market manipulation. But as I've said, as this is now a clear sign of market manipulation and a clear sign of consistent, consecutive and concurrent FTDs that are intentionally manipulating the Ape stock, Adam Aaron finally has that viable proof to do something about it. But guys, be sure to let me know what you think down in the comments below. And as always guys, be sure to ding that notification bell because that way you'll be alerted when I upload a new video. Cheers.